Okay, let's talk about standard costing. So budgets are big picture items and standard costing looks at the units involved. So before the year even starts, we'll set our standards at tight but sustainable levels, how much it should cost us to make each unit. We'll set standards for the quantity of materials, the price of the materials, the hours it should take us to make each unit, and the rate per hour we should pay our folks. We'll also look at overhead. We explain why it is overapplied and underapplied. And what we're going to do is compare our actual overhead, the debits to the overhead account, to what we would have applied if we worked as efficiently as we had planned to work. The standard costs are the ones that travel through our familiar T accounts. They go from materials, labor, and overhead into work in process, from work in process into finished goods, from finished goods into cost of goods sold. And the differences between what we actually spend and our standards are captured in variance accounts. So the calculations seem complicated, but they really aren't. We subtract from left to right. We take our actual quantity times our actual price. We subtract standard quantity times standard price, and that gives us our total materials variance. To break it down to price and quantity, we'll take what I call a magic square. We'll put the magic square in the middle, actual quantity times standard price. Again, we subtract from left to right. Actual quantity times actual price minus actual quantity times standard price. And what's going to happen, somewhat counterintuitively, is positive numbers means that the actuals were higher than the standards. So those are bad news. Those are unfavorable. Then, so like I say, actual quantity times actual price minus actual quantity times standard price gives us the price variance. That actual quantity times standard price minus standard quantity times standard price gives us the quantity variance. And those two variances should total up to your total materials variance. Sometimes textbooks factor those equations into something a little more algebraic. We don't need to worry about that. We can just use the magic square in the middle. Same thing for labor. We'll take actual hours times actual rate minus standard hours times standard rate, and that'll give us our total labor variance. Then we need to break it down into the price. Do we pay our guys too much? Quantity, did they take too long to do their stuff? So again, subtract from left to right. Actual hours times actual rate minus actual hours times standard rate gives us the price variance. Actual hours times standard rate minus standard hours times standard rate gives us the quantity variance. And the price variance and the quantity variance should total to the total labor variance. And just like in the materials, positive numbers are bad. They are unfavorable variances and they get recorded with debits. And some textbooks factor those subtractions into those two equations down there. We don't need to worry about that. The overhead is a different beast. We can spend too much. For example, if we use 1 gallon of lacquer per kayak when we're supposed to use 1 gallon and we use 2 gallons, well, then we spent too much. Or maybe we didn't work enough, because remember, our overhead is applied on the basis of some kind of driver that assumes a certain level of activity. And if business is super slow, we're not going to have that kind of activity, and so we're going to underapply overhead, and that's a bad thing. In this class, we're only going to look at the total overhead variance. We're not going to break it down into the controllable variance, which looks more at the variable costs, and the volume variance, which is more at the fixed costs. All we're going to look at is the total overhead variance. We're going to look at the actual overhead incurred. That's the debits to the manufacturing overhead account that we know so well. And we're going to compare that to the overhead we would have applied if we worked as efficiently as planned, whatever our driver was, whether it's standard labor costs, standard labor hours, machine hours, or kilowatts of electricity. If we'd worked as efficiently as we would planned, how much overhead would we have applied? So the formula is actual overhead, the actual debits to manufacturing overhead, minus the overhead applied if we'd worked as efficiently as we had planned. What happens is every textbook I've ever seen uses direct labor hours as a shorthand reference to our driver, and that's not necessarily what we use. As you remember from some of our problems early on, we can use direct labor hours, we can use direct labor costs, we can use machine hours, we can use electricity. So whatever overhead we would have applied had we worked as efficiently as planned, that's the overhead applied in that calculation for total overhead variance. Let's do the problem 11.1, total overhead variance. It tells us that the actual overhead that we incurred, 59,700 of variable, plus fixed of 21,000. The overhead that we should have applied, we created 4,800 units in that problem. The driver is direct labor hours, and our rule is $10 of overhead for every direct labor hour. It was supposed to take us 7,680 direct labor hours to create those 480 units. We had planned, our standard is 1.6 hours per unit. So we should have used 7,680 direct labor hours. If we had used 7,600 direct labor hours, and we used our rule of $10 of overhead, we would have applied 76,800. So again, we subtract from left to right, and 80,700 minus 76,800 gives us a total overhead variance of 3,900. It's a positive number, so it's bad news. And there's my ex-girlfriend. All right, I hope that helps.